Everyone, it's your host, Justin Burgess, back again. Today we're diving into the deep world of health insurance captives with the expert himself, Ian, regional practice leader from Roundstone. Buckle up and get ready to take your insurance knowledge to the next level. Ian, thanks for joining us today. To start, can you give us a brief introduction about yourself and the history of Roundstone?
Absolutely, Justin. Thanks for inviting me on and having me. Really appreciate it. So as Justin mentioned, my name is Ian Woidke. I'm a regional practice leader with Roundstone covering the Gulf South region. And Roundstone was started in 2003. And we were the first to bring the medical benefit captive or the captive insurance arrangement to the health insurance side. That 21 years of experience has given us a lot of knowledge and understanding of, how the industry works, what is good fits, what, things that we maybe want to shy away from, how to work within all the different players that come in, to the insurance world. And that experience has helped us grow to over 1,000 employers in our captive since 2003 and to return a chunk of the stop loss premium to those groups each year.
Great, thanks for sharing. Well, let's jump into it. So what exactly is a captive?
So a captive is a group of companies that are coming together to spread the risk of their individual insurance plan or healthcare claims and experience. But by sharing that, they're able to not only spread the risk, as I mentioned, but it also gives them purchasing power from a stop loss premium perspective. So they're getting the groups that are in the captive are buying it not as an individual company, but as a very large pool and spread out across tens of thousands of lives. So they're getting more competitive premium quotes from the stop loss carrier. And that pooling of risk and purchasing power is the 10,000 foot view of what a captive is doing and why groups join it.
What I like about it personally, allows a smaller employer, let's say, I think the minimum is 25, correct?
That is correct. Yep.
A 25 life group can act like a 1,000-person group. I would say the average group that joins a captive is anywhere from the 50 to 150 size range. Would you say that's fair?
That's what we're seeing in the industry.
So it allows smaller employers with limited access to data to get better access to the data. So next question is, what are the benefits of a captive?
Yeah, so Justin, as you mentioned briefly, the benefits of the captive is that it allows groups that traditionally, and by groups I mean employers, that traditionally have not been great fits for stop loss or reinsuring their health insurance on their own, standing by themselves. It allows groups to limit their risk from a stop loss perspective in terms of how much is going to lie on the employer before the insurance kicks in. But not only is it doing that, but it's allowing groups to take advantage of the benefits of going self-funded without the excessive risk, as I mentioned. And a big benefit of being self-funded is having transparency and view of your data from a claims perspective. So to know what is driving your cost, but then also, with that insight, because you're self-funded, having the ability to positively affect and do something about those claims by implementing different solutions and partners to drive down your spend on the healthcare side, which obviously drives savings into your own pocket, not the savings of the insurance company.
Thank you. That's kind of one of my big topics. I just did a video with Brian with Agility Innovation Partners, and the whole stick was around data transparency. So being a part of a captive allows employers to actually get control of their data. A lot of employers are level funded and you do get access to data, but it's not a whole lot you can do with it. Joining a captive, you can make decisions based on that data. So next question is, will a captive save my organization money?
Yeah, so, over the long run, captives and being self-funded within the captive will help you as a company save money. It may not happen in year one. We have some groups that do experience, significant savings in year one. But when you move to self-funded and self-funding in a captive, it's more of a strategic look at your benefits, and you're looking at it over time. So over the course of 5 years or more, and by being self-funded and joining a captive, you will save money over that long term because you will have the ability to positively affect change and savings into your insurance plan.
Yeah, that's a good point. So my kind of thought process is 4 out of 5 years, you're going to have lower than expected claims. 1 out of 5 you're going to have higher. And it's just over the long term, you're going to benefit. Next question is, what happens if our company has a very high claim, one that is greater than our company can afford?
Certainly. So that's where the captive is providing that protection for an employer. So as a company, you'll get a proposal and you will have a level of risk that you're comfortable taking on. And then any claim that is maybe a shock claim or surprise that's a super high cost, you're only going to be held to that threshold of liability that we established when the proposal was going out. And then the captive and the reinsurance carriers behind the scenes are going to cover any risk that exceeds what your risk level liability is. So that's the volatility protection saying, hey, we're not going to put you on an island and have you stand by yourself. We're going to limit your costs and liability and make sure that the captive is there to take on any sort of claims that go above that level.
I like this question because for my fully insured employers, it's getting baked into your renewal regardless if you have a high claim. For the level funded, you do have spec and ag, so you have some protection. At the end of the day, you are protected from the shock claims or the very large claims. Next question is a captive a good fit for my company?
Justin, that's a great question. We encounter that all the time. So obviously not every group is going to be a fit for the captive, whether the group is just not comfortable from a risk tolerance standpoint to want to go self-funding, or perhaps there is a risk that's going on with the group that is not appealing to Roundstone. So Roundstone in its entirety, and to simplify it as best we can, is we're managing the captive pool. So we need the captive to run well so that the employers who are participating in that captive are benefiting from being in a captive, right? You add too many bad apples to a pool, and no one wants to stay. So groups that are looking at the captive may not necessarily be a good fit that year because we may evaluate it from an underwriting standpoint and say, we're not comfortable with this risk at this time. But groups who are, good fits to captive are groups who want to look at their strategy over the long term, apply a strategy to their healthcare benefits, and not just look at it in short-term windows, that they have the right mentality to how they want to treat employees. They view them as assets of their corporation, not just cogs in a machine. And then finally, you're of a size that says, okay, I have the capability and the resources in place to take on this. And not that it's that much more work for you as an employer, but as you mentioned earlier, Justin, a lot of captives have a minimum size employer. So if you're a 5-life company, not going to be a fit. But if you're a 25, 50, 200 life group, you're going to be right in the sweet spot for joining a captive.
Yeah, I think my biggest thing is you need complete buy-in from the CEO, CFO to HR director. You need everybody pulling on the same rope and looking at this. We have a 12-month renewal. We get our renewals 60 to 90 days out, most likely closer to 60. There's nothing you can do in that short window of time. Going down the captive route, you're buying in for the long term. You're getting your renewal well in advance. You know what it's going to be. You're getting data on a monthly basis, so you can actually say, okay, this is how we're looking, and you can actually control it. So, well, thank you, Ian, for all these valuable insights. That's all for today's episode on the health insurance captives. If you have any questions or comments, drop them below. Don't forget to follow for more informative content. I'm also looking to interview other like-minded individuals in the employee benefits industry. If you know someone, please drop them in the comments as well, or reach out to me via direct message. So take care. Bye.
Awesome. Thanks, Justin.